Now, hello students. For this video clip, we are going to practice the general non-monetary exchange and exceptional cases for non-monetary exchange rules. And as we discussed in the class, in the general non-monetary exchange rule, we qualify for fair market value of these assets, the exchange. So we can use the fair value of old asset to measure the exchange. Also, we can use the fair value of new asset we received. That is the case A, the recognized gain or loss, record new asset at fair value new. So we record just as it is. But the problem is the exceptional case. The fair value is not determinable or exchange transactions to facilitate sales to customers and transactions lacks commercial substance, lack of the cash flows of the new asset or the old asset. In this exceptional case of the non-monetary exchanges, we don't trust the fair value. It has some intentional exchanges between two parties, so we do not follow the fair value of this asset, so it cannot be the reported in the fair value of asset in the balance sheet. Also, if there's no fair value identified, then we just follow the book value of old. So let's go to the part 1, non-monetary exchange of PPE when the fair market value is not determinable, or exchange transactions to facilitate sales to customers intentionally. And in this case, we have exchange A's PPE, the A company's PPE book value 24,000 for the B company's PPE book value $26,000. First, A corporation, no boot involved. That means there's no cash, the transactions involved in these non-monetary exchanges, and no fair value identified. So we know what the book value of the old one. So we put the PPE, the net book value. That is the net book value, right? PPE net book value of the that is the book value of old one, right? We exchange it. That's why we put this PPE in the credit side. How much is that? Right, that is $24,000. And then the new asset we received that is the fair value. Can we put here the fair value? Fair value we received, but we don't know what the fair value. So inevitably we put this $24,000, which is net book value of PPE for gone. So 24. Even though the B's PPE, the book value is $26,000, we don't care. You don't care. Because we want to know the fair market value of the new PPE into the acquisition cost. But this book value is not the fair value of this B's company. So we just put along with the book value of this old PPE, that is the old one. You guys understood? So this case is that one. So we just put new PPE as the same value as the old PPE at book value, or the case is C. So why don't you put this transaction, there's no cash involved, and the new PPE, which is the fair value assumed as the net book value of the old one. Then here we have had $24,000, the old book value, but now it is forgone. So minus 24,000. Okay, so the total asset, then there's no gain or loss. There's no gain or loss. There's no gain or loss is recognized. Okay? Because this, we assume that this $24,000 old book value is the same as the new, the acquisition cost of PP&E. So that's it. We don't have any income statement transaction related to gain. So for the perspective of the B corporation, no boot involved, no fair value identified. In the same way as the A company, we know the old PP&E. The B company knows the old PP&E, the net book value, right? Old PP&E net book value. How much was that? That was $26,000, right? $26,000. And then we now, how much was the book value? The book value, 26,000. Then when you receive $24,000, the book value of A's PP&E, when the B company exchanges it, now the new PP&E from the A company is therefore $24,000, and then we put here loss $24,000, $2,000, so that we can match. No, we do not put any the loss or gain. Why? We don't know the fair value of the PP&E. We don't know. So the new PP&E received by the B corporation from A company. So we put $26,000 along with the older PP&E of B's. So that's it. So remember, there's no gain or loss. This case, the A corporation never put $26,000, even though we knew that the B's PP&E, the book value was $26,000. Don't care. We don't trust this book value into our book value when we exchange, because the fair value is not identified. When you put this new PP&E, which is acquisition cost, it's not the book value of the counterparty. It's the fair value, but we don't have fair value, so we don't put any gain like this $2,000. No, we do not put any gain here. Instead, we just put $24,000, exactly same as the book value the company has had. Okay, and then now it's forgotten. So let's put this journal entry into the balance sheet. So new one has now 26, and then old one now forgone. Then 26. Also, we don't have any gain or loss transaction, so that we don't have any retained earning. That is the case B and C. Fair value is not determinable, or no boot involved in this case. Now, part 2, non-monetary exchange of PP&E. It also has the exceptional non-monetary exchange rule. Exchange transaction to facilitate sales to customers, intentionally the exchange it to increase the sales, ignoring the fair market value. So lack of commercial substance case is number 3. Transaction lacks commercial substance. Even though we exchange the PP&E, the PP&E should produce some probable future benefit calculated by the future cash flows, but it doesn't have the future cash flows, or it's hard to get the future cash flows. So that has no commercial substance, or lacks a commercial substance case. So we do not trust the fair market value of the exchange, the PP&E. So in this case, we have to consider here boot given here the A corporation's book value 18,000 and fair market value 16,500 and cash paid 15,000 and B corporation's book value 54,000 and fair value is now 31,500. And then do you see the boot involved? This case we should consider case D, boot given. In the boot given case, how they record? Always we should start from the asset the company has had, all the PP&E. That is the book value. That was the book value. How much was that? That the book value, the net amount was 18,000. Right? That was the 18,000 in the A's company. So we have to remove this 18,000 book value. Then cash was given to company B. So that is 15,000. And then next step, we should calculate loss. Now this fair value, we know this fair value 16,500 and the book value of this old one was $18,000. So how do you calculate it? 16,000, right? That is the difference between the book value and the fair value. The book value is greater than fair market value, so this is loss, 1,500. Then we put the new PP&E, the fair value acquisition cost, the fair value of new PP&E from the corporation B. Then we can just plug in. After calculating all the losses, 31,500, which is the same as the fair value, right? Or you can just put in 31,500. Okay, that is the case of boot given, and the case D. Case no gain recognized even if fair value is greater than the book value, and recorded new asset at the book value, old plus boot given. Then we recognize loss immediately. Now let's put this journal entry. Let's post here cash out, and then all the PP&E should be removed. Then new PP&E, the value of new PP&E is 31,500. And then loss, the difference between the fair value and the book value is minus 1,500. Should record it. And then corresponded into the retained earning. So the sum of all this asset is 16,500. Also should be the same. Okay. Now the B's perspective. Now B corporation now has received the cash during these exchanges. So loss recognition but not gain. Why? Take a look at that. Is the boot received case. Portion of gain if the company received the cash and then can recognize gain. So the company can recognize some portion of gain. But if the company recognize loss, now it should be recorded immediately. So let's take a look at this. The B corporations, always old one, all the PP&E, book value of PP&E. How much was the book value of PP&E of this asset? Is PP&E asset was 54,000, right? 54,000, and it should be moved. Should be removed, 54,000. And let's start from the easy one. Cash amount received by 15,000. And then loss amount can be calculated very easily. What is the loss amount? The fair value and the book value, the difference between two, right? A B company, the foregone. The B company is the equipment or the PPE foregone. Here, now the loss, how do you calculate? 54,000, because the book value is greater than fair value, 31,500. So the loss amount is now the 52,500. Then let's put the new PPE value, which is fair value. This amount we can calculate just plugging. So the 16,500 exactly, the fair value 16,500 in the market, the A corporations, right? So we increase the book value, the fair market value. We recorded the fair value of new PPE, and then this fair value can report it in the balance sheet. And then the cash amount we increased. And then the loss we put there, and all the PPE 54,000 should be removed. So let's sum up, and let's link this loss into the retained earning. It should be the same as total asset, 31,500. That is the case of E, when the boot received the company B. The company B received the boot, but the loss recognized. Okay, because the difference between the book value and fair value, the book value is greater than the fair value. Now finally, part 3. Non-monetary exchange of PPE, partial gain recognition when a boot received. Also the E case, but we cannot record the gain in full because we still do not trust the fair value of this new asset, the exchange, because in this case, the exceptional non-monetary exchange rule can be applied because exchange transactions to facilitate sales to customers intentionally, and transactions lacks commercial substances. Based on the conservatism, we recognize the loss, and then we can trust the fair value when we recognize the loss. But when you recognize the gain using the fair value of a new asset, we do not trust this fair value. Okay, based on the conservatism. So we just trust only gain, some portion of cash received out of total cash plus fair value. So let's go to the practice, part 3. A corporation boot received partial gain recognized. And here we started from the credit side. All the PPE foregone, book value. How much was that? Right, $24,000 here. 24,000 was 24,000. The book value of the old one, and then here we should record the cash. That is the obvious one, right? Cash received $12,000. And then we should record the gain. How much is the gain? The difference between 40,000 and 40,000 fair value and the book value 24,000. So 40,000 minus 24,000, and then the gain is 16,000. No, it's not the gain we can recognize in full. Because again, this fair value $40,000 we cannot trust, because that is the exceptional case of the exchange transaction to facilitate sales, or transaction lacks commercial substance, which is cash flows we cannot trust. So we do not recognize this gain, the difference between the fair value $40,000 and the book value of $24,000. We just only trust part of the gain from the exchange of this fair value of $28,000 and the cash received $12,000. So this gain should be proportionally calculated by only the cash amount. Cash amount portion, how do you get it? $12,000 divided by $12,000. Then what is the exchanged goods? This fair value $28,000, right? $28,000. So that we can just measure the gain 4,800. And then finally we just plug in this PP&E new value. We cannot trust this $28,000 the PP&E because that is the exceptional cases. No significant cash flows of this new asset, so we do not trust this fair value of a new asset. We cannot put this $28,000 in full. That's why we record the gain only the cash portion. So it should be calculated by just plug in the differences. So the new PP&E value is 16,800. Okay. Finally, the B corporation boot given but not gain recognized here. That is the now boot given case. Here, the case D, no gain recognized, and the company may record if the company has some gain. So let me show you old PP&E book value. That is the 26,000. Then it was 26,000. And then how they record the cash, that is the cash forgone, because the company gave the cash to the company A. So the cash received, because the cash received $12,000 from the company B. So the cash now reduced by $12,000. And then here, we have to record the gain here, because the difference here, the $40,000, the $28,000, the fair value of the PP&E the company has had, and the book value. So the fair value is greater than, so 28,000 minus 26,000. Then you can record the gain. No. The company cannot recognize gain. Just a general idea, in common sense, if the company give the boot and then can recognize gain, no, it's impossible. It is impossible. If the company received the cash boot, then the company can recognize gain, but only the partial gain in this exceptional case. So the company cannot recognize gain, just record new PP&E fair value. How much is that? We can just plug in. So $38,000 is the new PP&E the company received, even though the fair value of $40,000 of this new PP&E, the received from the company A, but we record only $38,000. That is the point. Okay. Then let's record this journal entry into the book, the balance sheet and income statement. Here, net all the PP&E $24,000 should be removed, and then record the new PP&E, this new value, and the cash received, and the gain recognized. Then here retained earning should be linked into gain. Then the sum of this asset should be the same as total liability and equity. So 28,800. That's it. Then this case, now old one, it was 26,000. Now minus 26,000 should be removed, and then the cash out minus 12,000, and the new one, new PP&E, now $38,000 recorded, and we don't have any transaction in gain or loss, so no retained earning related to this transaction. So let me just sum up. Then got it, $26,000. Okay, that's it. See you in the next video clip. Bye bye.